Hello everyone, and welcome to today's webinar, Cost of Capital Professional, Transparent, Simple, Free. Our presenters for today are Dr. Michael Crain and Ron Seigneur. Dr. Michael Crain of Florida Atlantic University is the author of Cost of Capital Professional. He is both an academic and a practitioner. He teaches and is director of FAU's Center for Forensic Accounting. Mike also consults with clients and is senior advisor to Miami-based top 100 accounting firm Kaufman Rosen. He received his Doctor of Business Administration degree from Manchester Business School in England at the University of Manchester. He has been a licensed CPA and practitioner for over 30 years and holds several certifications in valuation, namely ABV and CFA. Mike is a past chairman of the AICPA's Business Valuation Committee and has been inducted into the AICPA's Business Valuation Hall of Fame. He is a recipient of AICPA's Lawler Award presented by Journal of Accountancy for Best Article of the Year and AICPA's Sustained Contribution Award. Ron Seigneur is co-chair of the advisory board to the Cost of Capital Professional. He is a managing partner of Senior Gustafson LLP based in Lakewood, Colorado, where he specializes in business and intellectual property appraisal, economic damages, financial forensics, professional services firm consulting, and taxation. Ron has served as Chief Operating Officer and CFO for a 50-attorney Denver law firm and worked with over 350 professional service firms on a wide range of practice management issues. He has published over 80 articles on business leadership, succession and exit planning strategies, reasonable compensation determinations, business valuation, and related subjects. Ron has developed and taught a number of management, leadership, and advanced business valuation courses for the AICPA, ASA, and NACFA. In addition to the product author, Dr. Michael Crain, and the co-chair, Ron Seigneur, we have assembled an excellent advisory board who have been providing feedback and guidance, and you can see those members here. With that, I will now turn the program over to Dr. Michael Crain.
Well, thank you, Jarrett, and thank you, Adam, and welcome everyone. I see we have a large crowd with us, and we hope to be very efficient and get through our material and have some question and answers toward the end. So in the way of an overview of what the presentation is going to be, we will first discuss some reasons that cost of capital, while elegant in theory, has become complicated in practice. Then we'll discuss a possible way forward to reduce some complexity and cost of capital estimates. Then we'll talk about some characteristics of the new cost of capital platform, followed by a demonstration, and then we will have a question and answer session on the platform. We'll address question and answers toward the end of our presentation, and then we will conclude. So that's the overview of what we're going to be doing in this presentation. In the way of teeing this up, let's talk first about the state of the cost of capital practice. What you see here is a formulation of what we all know. It's essentially a discounted cash flow model, but more specifically, it says that the value of something today is based upon expectations of the future, of expected return and expected cash flows. So the theory of valuation is that it's forward-looking and it's expectational. Now, the practical problem is that one cannot observe expectations, and anything we do about expectations and the cash flows or expected returns are all estimates. In business valuation practice, we've gravitated to a common belief among many people that you can calculate a expected return. But if you focus in on what the denominator is, the letter R in this formulation, it's the expected return investors expect to get by buying the asset. So we do not actually calculate expected returns. The best we can do is estimate them. So we can calculate things that are future-looking in the physical sciences, but it cannot be done in the social sciences. Now, Dr. Pablo Fernandez, who is a prolific author in valuation. He's pretty well published. If you want to see some of his works, it's at SSRN. You probably get some material on that. He's described this current state of affairs and cost of capital and valuation as a schizophrenic approach to valuation. He describes that most authors writing about valuation in text or articles admit to different expectations of the cash flows, but most of them look for one precise, unique discount rate, maybe a discount rate taken to the nth decimal place. And he describes all of this as cash flows are formed in a democratic regime, and the discount rate is determined in a dictatorship. A lot of people believe discount rates must be calculated their way, and anybody who doesn't do that, they disagree strongly. They're rather dogmatic about these beliefs, and I would suggest that perhaps that's too strong. Just to tee things up a little bit, what you see here is expected return of a risky asset, asset I here, and it's the risk-free rate plus some kind of a risk premium. And this is the model for any kind of risky asset, including debt or equity. For equity models, we have variations of what you see here. With equity models, we have capital asset pricing models, in a form, Fama French 3-factor models. There's a 4-factor model and 5-factor model. All of these are in the academic writings, and many more models beyond that. In the business valuation community, they tend to have a high usage of the build-up model. And that's where this risk premium, which I've highlighted here in the rectangle, this is where a lot of the theory, the different theories and different practices arise in order to calculate or estimate this risk premium associated with a particular asset. Now, the most well-known model, I think, in cost of equity capital, and the most elegant, I think, is the capital asset pricing model, and that's what you see here. So besides the risk-free rate, there's two other parameters: expected market risk premium or equity risk premium, we often say in business valuation practice, and this CAPM beta that's associated with a particular asset. So using this model to estimate the expected return off of an asset, you need three inputs: the risk-free rate, the expected market risk premium, which is the premium expected by investing in risky assets, proxied by a market portfolio, the extra return of risky assets above risk-free assets. And then the beta is the relative risk of the particular asset relative to the market portfolio that's part of this expected market risk premium. So that's the capital asset pricing model. Now, in order to apply it, we start with risk-free rate, and this is the application for CAPM, modified CAPM, and the build-up model. Risk-free rate is an asset free from default, free from investment risk. That means there's no variance about the expected return. The reinvestment risk is often applied in practice by saying that, well, in business valuation practice, it's often said that's a long-term investment, so go with a long-term treasury security. So analysts use T-bills for risk-free rate when analyzing short-term investments like traded stocks, business valuation and project valuation and corporate finance tend to rely on T-bonds, at least in the United States. In other countries, they may rely on some other things other than the United States Treasuries. The current risk-free rate, that's the spot yield on a risk-free asset. It's market-based. The spot yield is based upon whatever prices the risk-free asset is trading in the market, holding that asset until it matures. And once again, the idea here is risk-free is with that holding period by an issuer that's very strong, the United States government in the case of treasuries. For the investor holding to maturity, there's no variance around his or her expected return holding it to maturity. Then the expected market risk premium, that's the commonly known in literature. Some places you may see market risk premium or alternatively equity risk premium. In the business valuation literature, it's often called equity risk premium. In the finance literature, you often see it as market risk premium. And once again, what this represents, it's the expected market risk premium, the extra amount by investing in risky assets over a risk-free asset. And the risky assets, there needs, for practical purposes, there needs to be a proxy for it, for the market portfolio. And in the United States, common practice is to probably use the S&P 500 stock portfolio for a collection of risky assets in order to derive the equity risk premium. All right, so we have our first poll question here, and I would like for everybody to answer it. Adam, do you want to take us through this? Or?
Sure, sounds great. So the question is, how much of an extra return above a risk-free asset returning 3% would you expect to get, assuming you can invest in a mutual fund holding all stocks? So we have our options of less than 4%, between 4 and 5%, between 5 and 6%, between 6 and 7%, between 7 and 8%, or greater than 8%. And we'll just take a minute here to let people respond.
So I hope that people aren't listening to the business news today to influence their reports, their answers here, as the news in the last day or two has been sort of negative in terms of stock market direction. Okay.
All right, so let's go ahead and jump to our results here. So it looks like the majority, well, at least the most frequent response is between 5 and 6% by a third of individuals. And then in pretty close, almost tied for second, was between 4 and 5 and between 6 and 7%.
Actually, what I see out of this, Adam, is that we have a pretty wide range of beliefs about what people expect to get above a risk-free rate by investing in a mutual fund. So it's pretty wide.
No universal consistency. That's true.
Mm-hmm. Okay, and do we have another question, Adam?
Nope. Oh, it looks like we do. So the next question is, what do you believe is the equity risk premium? And so we have similar answers here. It looks like less than 4%, between 4 and 5%, between 5 and 6%, between 6 and 7%, between 7 and 8%, and greater than 8%. So Mike, do you expect we'll see similar results to this polling question?
Well, I don't want to bias the results there.
All right, well, we'll hold off then. All right. Wait just a few more seconds here.
And Adam, are we going to be able to take these results to this question and flip back to the previous one? Are we able to do that?
Yep, it looks like we can. So, yep, we can do that after we finish this pull out.
Okay, great.
All right.
Okay.
So
a few more seconds. Okay.
Here we go.
Okay. Not as much dispersion there.
No.
Now, let's go back to the first polling question results. In theory, the results to this question should be more or less identical to the second question, because the equity risk premium that we use in our models are expectational. And we use a broad portfolio. It can be in a Vanguard S&P 500 mutual fund or some other market proxy. And whatever we expect to get there above a risk-free rate, whatever we expect to invest is representative of what investors in general believe, at least in large numbers. So in my view, the results for this question, this first question, should be, at least in theory, similar to what we have in the second question. So if we look at the distribution to this first question, we have pretty wide variance, and a lot of people believe that it's going to actually be below 4% on this. Now let's compare it to the second question if we can. And I suspect we got a lot tighter variation here, and I suspect people are answering this particular question based upon what they do in practice, and which seems to be different than what they expect to get from their own investments. So interesting results. All right, so let's talk about this market risk premium. As we saw in that first slide, especially what people believe that the expected returns are going to be. Dr. Pablo Fernandez surveys experts almost every year of what they believe a market risk premium. That's the extra return above a risk-free rate. And these are the results from the USA respondents for this year. There were 1,348 respondents. The average is 5.4%. Take a look at that standard deviation. It's pretty wide, and that's similar to the results of our first polling question. The minimum from the experts is 1.3%, a maximum of 17.8%. Now, I don't know if that's just one outlier on the extremes or not, but as you can see here, just with the mean and the standard deviation, it's pretty wide in the beliefs of what the market risk premium is in the United States among experts. Now, just to put this a little bit more concrete, let me just have a refresher here of standard deviations. So if the mean of the Fernandez among experts of the market risk premium is 5.4%, take a look at the standard deviation in that. And as you can see, it's pretty wide. So there's a wide difference of opinion of market risk premium among the experts, the 1,300 respondents. And that's sort of what I interpret that first polling question result to turn up. All right, back to the CAPM just for a moment. So the crucial aspects here are the risk-free rate, the market risk premium, and the beta. In the build-up in business valuation practice, we oftentimes do not have adequate proxies for beta, so that's oftentimes where we end up going over to the build-up model, which gets around the beta, for better or for worse. That's CAPM. Then we have the build-up model. Build-up model, we don't have beta, but we have these other things here, one or more risk premiums. And so that's sort of where we're left with CAPM or a variation of it or build-up model. Now, the build-up model has led us to a world of complexity in estimating cost of capital, especially for private companies. And we've created a literature base and methodology that could compete with Rube Goldberg. And for the younger folks in our audience, or those outside the United States that's listening in, when we get offline, just if you don't know who Rube Goldberg is, Google him. He is a cartoonist, very smart guy that builds some complex models in animated form as a form of humor. What we want in our cost of capital models is something like this, but in business valuation practice where things have evolved today, this is what we have. So the theory of CAPM and its modifications and the build-up method are elegant. They're straightforward, at least in theory. But in practice, have differing opinions about what to do, how to measure things, and it's resulted in a lot of complexity. Just to highlight an example here, text that a lot of business valuation practitioners may have in their library is Cost of Capital, authored by Shannon Pratt and Roger Grabowski. It's a thorough and comprehensive writing on cost of capital, and it's 1,300 pages and weighs almost 4.5 pounds. And I think that it's very well done in terms of pulling things together, but I'm not sure that after reading it that it clears up cost of capital issues that have been around for a long time. After reading it, I suggest that it might raise more questions than answers. We have risk-free rate. Do we normalize it, or do we take the spot rate, beta? We have all sorts of ways to issues, what years to observe, what frequency, monthly, weekly, what have you. Then there's different kinds of betas, smooth betas, some beta. Then there's levering and unlevering. And then we get to the equity risk premium. So I'm not sure that where we have evolved to in terms of documenting all of these dozens or maybe even hundreds of ways to look at things and measure things and what have you have made things any clearer. So where does that leave us? In terms of generalities, simpler is often better. And since for centuries, since the ancient times, a lot of prominent scientists and philosophers have stressed that there's an important idea of explaining things. And their idea is that simple ways of explaining things are usually more accurate than complex ways of doing that. And this is an idea that's called the principle of Persephone or Occam's razor. And it essentially says that simpler solutions tend to be better solutions than complex ones. And you can actually demonstrate this with mathematics. The idea stresses signal over noise. By adding more and more complexity to explaining things, you tend to introduce noise, which takes the attention off of the signal that we're trying to get to in the first place. So along this idea, we're dealing with models. Models is an estimation of the real world. Simpler models tend to do a better job in explaining a messy world. Again, this can be demonstrated with mathematics. By introducing more parameters, each one has an error rate around it, and when we combine more parameters with more error rates, it tends to increase the error of the outcome. That's a general way of looking at models, simpler versus complex ones. And where I think we've sort of evolved in cost of capital and business valuation practice is a belief that I don't think that's true, that complicated math, although it appears scientific, it gives the illusion of precision. And a lot of people actually I believe that more complicated math is getting to the better answer, where I think that a simpler way of doing things probably gets to a better answer, and the illusion of precision is not where we want to go. Now, all of this raises the issue of, well, we're back to introducing subjectivity into cost of capital estimates. And what I suggest is, when we deal with estimate rates of return, estimates of the future, which we cannot observe, still have to apply judgment to that. And that brings us back to, I think we need more professional judgment in cost of capital estimates rather than less professional judgment. First of all, what's the alternative to less professional judgment? No judgment or unprofessional judgment? Artificial intelligence isn't here. Maybe it'll get here in some time in the future, but it's not here right now, and professional judgment still matters. We're still in a social science, not a physical science, and in the social science, there's no laws of nature. We don't have any formulations to predict with precision about what's going to happen into the future, because we live in a messy world. It's complex people, complex systems. Professional judgment still matters, and it's based upon professional knowledge, evidence, the context of the particular problem, and careful thought from the trained professional. It requires integrity and objectivity, and at the core of applying this, it needs principles and not rules. If we had rules, we could get a computer to do all of this or most of it. But we don't have any rules that give us precise ways to estimate what expected returns are. So we're back to imprecise ways to estimate the future. We have to deal with that with principles. We have to apply professional judgment. Professional judgment still has a place in cost of capital estimates. And in applying professional judgment, you need data. And the data, we don't need any black boxes. We need transparency in order to provide information to the professional in applying their professional judgment. So that leads us to our new cost of capital platform. Our data sources are from the University of Chicago's Center for Research in Security Prices, CRSP, Dr. Aswath Damodaran's data library, and Dr. Damodaran has graciously allowed us to use his data library, which is freely available on the internet. And I'm grateful to him to allow us to be using this in the cost of capital platform. We also have data provided by the Federal Reserve, and then we get to information that allows professional judgment. And the practitioner is allowed in the platform to make overrides to much of the information, and also allowed to input unsystematic risk premiums, the risk premium associated with a particular company beyond what's already been captured in the platform. So these are sources of data from well-known sources and also from the user applying professional judgment. In terms of risk-free rates on the platform, the data for risk-free rates on T-bond yields after 1941 come from CRSP. Prior to the early 1940s, CRSP does not provide Treasury bond return data because Treasury bonds before that time had different characteristics than T-bonds do since that time. And CRSP does not believe that you can compare the returns prior to the early 40s to the T-bond returns since the early 40s. So they did not provide T-bond returns prior to the early 1940s. So to provide information for practitioners prior to 1942, We obtained T-bond return information from Dr. DeMotorin's data library, where he provides returns on 10-year Treasury bonds. And then we try to reconstruct the 20-year T-bond return by taking Dr. DeMotorin's 10-year returns prior to 1942 and adjust for the historic difference in returns between 10-year and 20-year T-bonds. For our platform, we provide information on 10-year and 20-year T-bonds. In business valuation practice, it's common for historical reasons, I think, to use 20 years to maturity on the Treasury bonds. In contrast, in the finance literature and corporate finance practice, it's relatively common to use 10-year T-bonds. So we are offering both 10 and 20-year and allow users the freedom to make their choices of which of these two securities to use. Then we get to the equity risk premium. And that's, as we could see from those two earlier polling questions, there's a lot of opinions about what it is. And it's a pretty wide variety, as we saw in the Fernandez poll. In terms of how the cost of capital platform presents information, this is a little summary of what is available. So in the first sections, in the first rows, you see a historical approach that's looking at past returns of the market portfolio, the S&P 500, in comparison to the T-bonds. And for different periods of time, you have 4 rows. A couple of rows are starting in 1926, and I've got demonstrated here through the most recent full year. And we have that with the 10-year T-bond and the 20-year T-bond starting in 1926, and then the same idea starting in 1963. And then we have the implied approach. That's from Dr. DeMotorin's models. We'll talk just briefly about what those are, but this is the kind of information that you will see on the cost of capital professional platform that's available to you. And as you can see, comparing to the bottom to the Fernandez poll, the estimates for equity risk premium fit within a reasonable range, I think, of the Fernandez findings, where he surveyed experts. Now, there are some people that dogmatically say, here's the one way that you calculate an equity risk premium, and if you don't do that, then you're wrong. Well, actually, what we're doing is we're estimating the expected extra return of a market portfolio above the risk-free rate, and there's no way to calculate that. We talked about that earlier, and some people dogmatically say my way is the right way and your way is the wrong way, and I think what this amounts to are from the scholastics in the Middle Ages of debating how many angels can dance on the head of a pin, because as you can see, the results fit within a reasonable range as compared to what experts believe in the Fernandez survey results that you see at the bottom. So watch how many angels can dance on the head of a pin. Now, there's several ways to estimate equity risk premium that's in the platform. One's the historical approach. That's where you observe historical returns of risk-free assets and the historical returns of the stock market and calculate the average difference between the two as a proxy for the equity risk premium. So this difference, using historical data, is the extra return investors actually received in the risky stock market instead of investing in risk-free assets at the time. Now, the notation you commonly see is at the top, but I'm a bit surprised, but this top notation confuses a lot of people with how to apply it. And I think a better expression for all of this is what you see at the bottom. The expected return on of an asset I is the expected risk-free rate plus the expected extra return above a risk-free rate in the risky stock market plus whatever risk premium you want to add beyond that. I think this bottom expression is superior as a way of thinking about all of this. So how do you estimate the expected equity risk premium? What's in people's minds? Well, the historical approach is this. This looks messy, but it's really not. For some historical period of time, you determine the average return of the stock market and the average return of risk-free assets, and then you calculate the difference between those two averages. And the assumption here is that the past gives us insight of what the future might look like. So as an example of this, assume the S&P 500, which is a proxy for risky stocks, has had a higher average, has had a average annual return of 10%. T-bonds, which is a proxy, assumed to be a proxy for risk-free rate, has had an average annual return of 4%. So what has happened in the past is that investors in a risky stock market would have earned an average of 6% more than they would have by investing in risk-free assets. And then the idea here, using historical data, is make an inference from this experienced 6% extra return in history, make an inference of that gives us some insight into the future. Now, the implied approach of equity risk premium estimation, the implied equity risk premium, a big proponent of that is Dr. Aswath Damodaran. And this topic is too complex for this presentation, but here is a paper that's available on the internet written by Dr. Damodaran, in which he describes his models for equity risk premium. And once again, we provide his data on what he has estimated the implied equity risk premium is based upon his models in our platform. So once again, here's a summary of the information that's available on the platform. The historical information is toward the top, and then the implied equity risk premium for Dr. Damodaran's models are toward the bottom of this table. There's other approaches of estimating equity risk premium. There's survey the experts. Dr. Fernandez does that on a regular basis. His surveys are available on ssrn.com. That's the website for academic type papers, social science research network. Then another approach for estimating the expected equity risk premium is something that has been called the supply side equity risk premium. In theory, this is an approach to estimate an equity risk premium. In theory, it removes investors from the picture. It removes investors from the picture, and what takes its place? Producers in the economy, essentially companies. There's not one supply side model. There's multiple models that are out there. At the bottom, I've given you a link in reference to a paper written by Roger Ibbotson and Ping Chan from 2002. I think it was published in 2003 in Financial Analyst Journal. And this describes their work. And if you look at that, they describe 6 methods of decomposing returns. So at the end, there's multiple models in supply-side models. There's not just one. There's multiple models out there. And once again, in theory, it removes investors from the pictures. So that's the equity risk premium. Then we get to the size premium. The claim is that smaller firms smaller stocks outperform larger stocks on average. The first two references here, Bands and Fama and French, are probably the most prominent papers that established this claim. And then the last three references that I list here, starting with Horowitz, then Fama and French, and Alquist, they find that the size premiums changed in listed firms and traded stocks, and they seem to have diminished or disappeared since the early 1980s. And what happened in the early 1980s? That's when Bands first documented the size premium. So that's where we are in the academic literature. That's the evidence on the size premium. So what does that mean? Well, in the cost of capital professional platform, we give you the option of choosing the years in which you want to look at the historical data. What I've done here is look at essentially the size premium for decile 10, the smallest group of stocks, depending upon if you start your data at 1928, 1963, and 1982. And if you look over in the right-hand column, what you can see is the size premium derived from average decile 10 returns and with a difference to S&P 500 returns. And the size premium has fallen, which is consistent with those academic papers that you see on the preceding page. Now, what does this mean? This means that in listed firms, things have changed. How that applies to private firms, you're not going to get that out of publicly traded data. So that's going to be something that's going to be discussed. Now, one thing that I have had a few people comment on is that the size premiums that you see here differ from the size premiums in the Duff and Phelps estimates. And the explanation for that is our methodology to calculate the size premium is the difference between decile 10 return and the S&P 500 return. The Duff and Phelps methodology to calculate a size premium is using a capital asset pricing model. And what that model essentially occurs is that in the smaller decile firms, such as decile 10, those firms on average have betas higher than 1. Betas higher than 1 in the smaller firms. And by using the capital asset pricing model to estimate size premium, that model tends to siphon off some of the extra decile returns above the S&P 500. Consequently, the Duff and Phelps estimate of the size premium is lower than it is in our calculation, which is the difference between the decile return and the S&P 500 return. Measure of firm size. Our measure is market value of equity. That's the most common measure in academic research. And I've given you a reference here that using non-market-based measures of firm size has been dodgy. Using non-market measures of firm size, such as book value of assets, annual sales, number of employees, the academic research shows that they're not reliable for establishing a size premium of smaller listed firms that are not otherwise predicted by beta in a capital asset pricing model. In other words, beta is just as good of a measure. And in the platform decile 10s, there's no subdivision of decile 10 firms. The academic research has shown that smaller listed firms are small for reasons such as their poor profitability, cash flow problems, and high leverage. What this means is that if you're going to try to use 10A, 10B, and so forth, you've got to face the characteristics in those subdivisions of decile 10 that they could have these kinds of characteristics that the listed firms do. And I have a few references here in addition to the ones that I've given you earlier. And
all right.
Now I would like to turn that over to and let somebody else take it for a while. Jared?
Okay, hi, this is Adam. So really quickly, I just want to remind all of our listeners of the CPE codes for today that they will need for their survey at the end to receive their CPE credit. The codes for today's webinar are 3662 1489 3355. Again, the codes are 3662 1489 3355. Also, if you have any questions for our presenters, please use the chat feature on the left side of your screen, and we will answer those at the end of our presentation. Okay, I will now turn the screen over to Ron Seigneur, who will provide us with a web demo.
Thank you, Adam, and thank you, Mike. Before I start into the demo, I just want to give a quick shout out to Mike as the author of this platform and the BVR technical team that have worked tirelessly to put this together, and my co-chair, Adam Manson, as well. So what we're going to do here is spend the next roughly 30 minutes looking at the platform itself. And you should have the cost of capital professional screen up in front of you, and I'm going to walk you through what's in that screen so you can see what's there. And I'm going to start out by clicking on the tab that says User References. There's a place here if you have questions or you need feedback as you get into it, you can click on that. It will send an email to the technical team that will be pretty responsive to you. But I'm going to go into the frequently asked questions detail that you can see on your screen here. There's a lot of information, and I would really encourage you to spend some time because this is what will define what you are seeing in the screens as you're actually inputting information into the platform. It has a lot of information in terms of where the sources are for the information that we're drawing from in the platform. And I'm not going to take the time to go through each of these questions and answers, but we're also looking for input too as we try to get input from the users during this free period to try to make this as useful as possible in terms of the questions and answers that we can provide folks. You've also got a question here, what is the source of the data for the cost of capital professional platform? And you can see in the answers there's links that take you directly to the Federal Reserve. If you want to see that information and drill down into that so you can spend some time looking at the Federal Reserve data. I'm going to go back into the frequently asked questions here again and get back to, sorry here. If you want to look at the Center for Research on Security Prices, you can click through and go directly to that site as well. I would encourage you to spend some time looking at this site. This is the source of the information that compiles much of the information we have in the system. And then there's also a link to Dr. DeModerin's webpage and his data library that is really extensive. So if you haven't spent time here, this will be a new path for you to follow. And we're going to see some other links in just a second here. Lots of information on the different inputs and the choices. One of the objectives of our platform is to empower the users to make their own choices, as Mike indicated, to use your professional judgment in terms of what you select for risk-free rates and what you select for the risk premium and size premium. And you're going to see that as we get into it. Again, lots of information here. I would urge you to take some time and read through it. One of the things I want to get to here is the beta question here. You can see, are there any online resources for industry CAPM betas that I could use to populate CAPM beta or derive an industry risk premium? Yes, and we link directly to Dr. DeModerin's data where you can see industry risk premia here in the betas for various industries that he publishes. Again, I just want to make sure that you know that you can link directly through to that information. With that, let's go back to the platform itself and get into trying to walk through a couple of inputs. I've set a company here, Acme, and I've set a valuation date. You can go into the screen here and select your valuation date. You can input your company name. The first choice that you're going to come to is the returns reference year, and you'll see that you have three distinct choices, 1928, 1963, and 1982, or you can actually enter a custom date, and it will calculate based upon that custom date. We're going to start with 1928 as our returns reference year, and we're going to say we want data through 2017. And then what you see down below are the tabs where you input first your risk-free rate, and we reference the 10-year maturity bond rate as of our valuation date is September 30, you can see up above, and we get the rate that comes from the Federal Reserve website as of September 28 of 3.05% for a 10-year maturity, or 3.13 for a 20-year maturity, or you can input a custom rate if you want to use something other than those directly calculated choices. The next screen excuse me, is where we look at our equity risk rate premium choices, and you can see that we have the choices that come from the CRSP calculations, and you can see how those numbers are derived over in the right column, where you can see that we take the S&P 500 average total return over the period that we've selected. We deduct out the 10-year average return T-bill rate for the first choice, and the 20-year average rate for the second choice. And you can see that I've selected the 5.94, the 20-year T-bill rate above the S&P 500 average. You can also select any of the DeModern choices here, or you can actually put in your custom equity risk premium if you so desire. For this first calculation, we're going to use a 20-year T-bill equity risk premium. And now we're going to go to the size premium tab. You can see that what we have here is the decile report. And you can see that we have that constructed 1 through 10 deciles, and then we have the microcaps and the other combinations that we used to get in the SBBI book that was from Ibbotson and then Morningstar. I've selected the 10th decile here, and you can see that the size premium for the period 1928 through 2017 is calculated to be 8%. So after we've made these choices for our equity risk premium, yes.
Ron, could you run across the column headings of what's on that screen?
Oh, absolutely, absolutely. We have the deciles that you can see from the largest to smallest, and then we have the count of the number of entities that make up that decile, and these are based on split by market cap. We have the smallest in each of the categories and the largest entities, the min and the maximum. And then we have the mean annual return and then the calculated size premium. Is that what you were looking for, Mike?
Yeah, and the count, the number of firms, and the size of the firms for the minimum and the maximum, that's for the most recent period of time.
Thank you. Thank you. After we've made these selections, you go to the tab for cost of equity, and we have two different choices here. We can do a build-up model for cost of equity, or we can do the CAPM cost of equity. And for this first iteration, let's use a build-up model, and you can see that we've included the equity risk premium and the size premium we've selected. And I'm just going to input, for sake of example, a 6% on systematic risk, and then look at the summary. Let me get back to that here. I got to scroll down just a little bit. Here. Oh, I guess I got to select a risk-free rate. So that's why, see, it wasn't letting me produce the summary because I hadn't, when I did the custom screen over on this risk-free rate, I hadn't selected the 20-year T-bill rate. So now we've input those, and you can see in this summary, it explains what we've used to build up this particular calculation that results in a 23.07% cost of equity. Let's go back and click the capital asset pricing model as opposed to the build-up model in this tab for the COE. And you can see in this example, I've input a beta of 1.4%. Where does that beta come from? It comes from outside research, looking at the Demoderan information that we've shown you how to link to, and that calculates the equity risk premium as adjusted. I've put in a size premium here. Let's just change this to say 3% for this particular example, and go back up and look at the summary information. And you'll see that it's changed from the build-up model to the CAPM iteration here, and we end up with a cost of capital of 22.45% using those inputs. I'm going to go back now, and I'm going to select a 10-year maturity just to show that you're flexible there. I'm going to come back on the equity risk premium. I'm going to use just to show the flexibility, the Demoderan equity risk premium, the implied equity risk premium. We're going to come back here. You can use this. Let's just use the microcap, the 9 and 10 here. Let's come back, and you can see that it inputs those numbers. Down here, you can see on the build-up model, instead of using unsystematic risk, we can also look at betas, the industry betas that you can source from Demoderan or possibly other sources. And I'm going to, for sake of example, put a 1.2 beta. It calculates an implied industry risk premium. On top of that, I'm going to add 2%, 200 basis points for a company-specific risk premium in this example. Go back, and we're going to look at the summary, and you can see that it's calculated a cost of equity of 16.99%. Now I'm going to take us a different direction. I'm going to go back to the equity risk premium, use a 20-year maturity. I'm going to come back up before I do that, though, and I'm going to change my reference year from 1928 to 1963, and we're going to go back through and make the same choices, but what you're going to see is the equity risk premium and the size premium particularly have been recalculated based on the calculated numbers from 1963 through 2017. So if we use and I want to match up, if I'm using a 10-year maturity for my risk-free rate, I'm going to come over here and use a 10-year T-bill maturity for my equity risk premium. I'm going to come down in the size premium information here, and you're going to see that the size premiums have changed rather dramatically, where the 10th decile in this case from 8%, which it was in the other examples, is now 3.88%. Because of the change in the orientation of the returns on small companies with the shorter horizon from 1963. If we come back and we do a cost of equity build-up model, and we put in, for example, a 6% on systematic risk, we can come back in here and look at the summary, and our cost of equity in this example is 17.52%. We can come back and we can calculate the CAPM example here. We can come back and adjust whatever we'd like to in terms of the beta, the size, the specific company risk. We can put in, say, 4% and go back to the summary and see what we have. So what you see is you have a lot of flexibility to make your own selections for the items that build up, the components that build up your cost of equity under a build-up model or a CAPM model. You're going to have to make some choices on beta coefficients, and you're going to have to take a deeper dive into that. I know many of us as valuation analysts have not done much in CAPM, but it's here. So you understand the theory behind it. I would urge you to take a close look at the click-throughs to Dr. Demoderan's information on his data library. I'll make reference to a couple things that you can see at the top here. There is a tab in the upper right that says recent that isn't operative yet. It will be, where you'll be able to save your work product and go back, and we're trying to determine how long will allow you to save work product. It'll probably be for at least 120 days, but that's still being sorted out. So note that is not functional. The download too, that is also under construction, and during this test period that we have through the end of the year, that's not operative yet. Again, I really would encourage you to spend some time in the FAQ detail, read that, click through to the sources you see there. Play with the user input. You have lots of flexibility. I think you're going to find a lot for many of the listeners today. You're going to find a lot of things that will be that'll challenge you. It'll challenge your thinking on size as you use the reference years other than 1928, and you start looking at the returns that you get using 1963 and 1982 that have academic underpinnings, as Mike covered in some of his discussions. That's a quick walkthrough what we have here in the platform itself. And with that, I'm going to turn it back to Adam.
All right, well, thank you so much, Ron. So we have a bit of questions that we're going to get to, but really quickly we wanted to point out, if you don't have free access to the Cost of Capital Professional, we are offering a free trial with complimentary access through the end of the year. So if you visit the above link, you can register and you can get your free access immediately. And you can also find this on our website. If you go to our main menu, it's listed as a product on there. And after you've had a chance to go through and use the platform and kind of test drive it yourself, we'd love to hear any feedback or suggestions that you may have. So if you do have any comments, please feel free and contact us at info@bbresources.com. And just a quick note, we will have 2019 data, so the year-end 2018 data will be available within the platform in late January 2019. And while there's no option to purchase any subscriptions through our website now, since we're still in the free trial period, we'll be making that available at some point in December. But at that point, if you do purchase, we're offering 14 months for the price of 12. And if you want to learn more about any sort of pricing or any special deals we have, here's some contact information where you can get a hold of an account rep that oversees your territory and can provide you with more information. All right, so with that in mind, let's go through some of the questions we've been receiving. All right, we have one here that says that it seems that the reference year substantially dictates the outcome. How do you decide which reference year to use? So I guess that's, how do you decide which start year to use since it really affects your size premium?
This is Mike Crain. That's not really a scientific, that's a good question, but it's not a question for science or for finance. It's really an epistemic question, and it essentially boils down to this. What version of the past do you think is best indicative of the future? And that's got to be determined by the individual. So if you wanted to determine how long it's going to take you to drive from your home to your office tomorrow morning, are you going to determine how long, are you going to base it upon how long it's taken you over the past week or the past 25 years? And in that particular case, it's probably, given those choices, the past week, because things have changed over the last 25 years. New roads, other traffic, new cars on the road, and so forth. This is not an easy question. And essentially it gets down to the issue of, has something important enough changed in the markets, in investor behavior, in information available, I can go on and on, over the past 90 years that change rates of return. And I think logically you would have to admit that it does. And there's no, as I said earlier, there's no laws of nature here that says there's some equilibrium out there that all rates of return for the S&P 500 or size premiums through laws of equilibrium go back to a certain level. That doesn't exist in finance. So the answer to your question is going to be determined based upon the individual, and I'm going to leave that to others to discuss at seminars and conferences and write articles about what they believe what version of the past best predicts the future, at least in this domain.
All right, thank you, Mike. So we have another question kind of along similar lines. The question is, does the return reference year affect only the historical size premium, or does it also affect the ERP?
The size premium is all based upon historical data, so the reference years does affect the size premium. For the equity risk premium, as we said earlier, we get there's two presentations there. One's using historical data. That would change with the reference beginning year. For the implied equity risk premium using Dr. DeMotoran's models, that does not change. That is Dr. DeMotoran's estimate of the equity risk premium on the year preceding the valuation date.
Okay, thank you very much. So we have another one here. It says, on the cost of equity screen, is size based on revenue size, or a size based on total assets, or based on something else?
Market capitalization. So that's the market value of a firm's equity. As I said earlier, that is the most common measure of firm size. That's in the academic literature, and I believe I gave some references to that. I also gave some references that in the academic literature, non-market-based measures of firm size have not performed any better than betas, and have tended not to be used. Other forms of firm size have tended not to be used in academic literature.
And we have a question here. So it looks like they may have missed this during the demo, but it just came in. It said, is there a way to use an industry risk premium when using the build-up method calculation in the online platform?
I'll address that one. There's the ability to put in a risk premium for both industry and company-specific risk, or to put in an overall on systematic risk, which would incorporate both. If you're using industry beta information to calculate an implied industry risk premium, then you'll have to just then add to it company-specific risk. But it does allow you to just use an overall on systematic risk, which would incorporate both industry and a specific company risk.
Let me just elaborate on that, and Ron touched on that in the demonstration. Dr. DeMotoran presents industry betas, and he's got levered and unlevered. You can use some mathematics, and the platform has this. Take the industry beta, such as 1.2, and from that you can derive an industry risk premium out of that.
Great, and we do have a question here. It asks if the data is downloadable to Excel. So right now we are working on a download function, so all your information as well as all your sources and all your calculations will be downloaded into Excel. But in the meantime, your information, you have the ability to copy and paste it either into Excel or into a Word document for your report. But that valuation, or excuse me, that Excel download, we expect to have completed here by the end of the year. And we have a handful of questions that are kind of similar, so I'll kind of ask them together as a group. So we have a lot of attendees asking whether you can change that start year where your returns are measured. So do you guys just maybe want to address that a little more fully? So maybe outside of the pre-selected years, is it possible to, select a custom year if you wanted to go back 20 years or 25 years?
Well, let me start on that one. Yeah, let me start on that, and then I'm sure Mike will elaborate. You can select any year from 1928 forward if you select the custom choice in the drop-down screen versus 28, 63, or 82, and you can put in a custom start year. But one of the questions, and Mike, maybe you can touch on this, is a couple of questions I've seen is why aren't we using 1926 to be consistent with what Roger Ibbotson first used in his studies?
Yeah. Let me first of all get into the 1920s, the 1960s, and the 1980s. Those are the three choices and then you have the custom choice. The 1920s is, you see that in the literature, and you see it here because that's the beginning of the data in the CRSP databases, Then you also see in the academic literature, and you see it here, the 1960s. And that's the first data in the CompuStat database in which academic research is used. So that's why you see the 1920s and the 1960s is because of data availability from whatever database the researchers are using. And then the 1982 is based upon the Bands paper for the size premium, first documented in 1981. Now, getting back to Ron's question, the CRSP data, first full years of returns are 1926. We're using 1928 because we have to borrow Dr. DeMotoran's data for the Treasury bonds, and his data begins 1928. So to align things consistently, we have to use the 1928 data rather than 1926. We did not arbitrarily remove 1926 and 27, and quite frankly, you're not going to change. You're not going to move the needle in comparing 93 years versus 95 years of data in there by that too. So short answer is 1928 in order to align with the first year of data provided by Dr. DeMotoran.
Great. And we have another question, which is, how often is the data updated? We are updating the data quarterly. The calculations that you see, putting aside the risk-free rate, which comes on the valuation date, the equity risk premium and the size premiums are all as of the end of a calendar year preceding the valuation date. The data is updated quarterly from CRSP. The relevance of that is that occasionally CRSP finds some input errors or some omissions that they later fill in. So we refresh the CRSP database on a quarterly basis from information they provide. That probably changes things out to several decimal points, but nothing substantively. Excellent. We have another question here. It says, the historical ERPs that I am seeing appear to be lower than what I used to see from Ibbotson. Is it the same methodology?
I don't know what he's normally seeing, but I think it's the same methodology. Those are what we're showing is arithmetic. If the person asking the question is comparing it to geometric averages, then yes, he's going to be looking at lower numbers from there. But I think that our numbers coming from Ibbotson Associates are aligned with Ibbotson Associates' arithmetic returns are aligned with our historical returns.
All right. So another question is, I have a valuation date that is from 5 years ago. How far back can I go in the tool? I guess with the valuation date.
I don't think he's going to have a problem. 5 years. Go back. Ron, do you want to address, maybe give a demo? I don't know if you still have your screen on, but do you want to do can you do a brief demo, or is that just getting too complicated?
Yeah, let's go back and take a look at that. So we're back here you should be able to see the screen now, and I'm going to choose June 30 of 2015. I'm going to use a 1982 as my returns reference year. Let's come down and look at the risk-free rate. And you can see that has pulled the risk-free rates as of June 30, 2015. We'll use a 20-year maturity for that particular input. equity risk premium, you can see that we use the CRSP data, 20-year T-bond returns 2.7%, and then we're going to look at the historical size premium. Yes.
Ron, up above, you have to change your reference into your.
Okay.
Thank
you, Mike.
There you go.
There you go. Got it. So those are consistent. I'm going to choose my 20-year risk-free rate, 20-year CRSP rate. And then here, just to reemphasize this, and I think this is indirectly responding to some of the questions, is the calculation for the size premium based on the 1982 beginning reference year shows the 10th decile has less than a 1% size premium, and I know that's a mind bender for many of us compared to what we've been used to seeing based on the 1926 or 1928 reference years that we've been used to seeing until now. But the academic literature bears out that the returns on small stocks have in this instance pretty much matched large stocks in terms of a very small premium based on the calculation for this particular period. If we go in and we do a yes?
Sorry, back on that size premium, just as a matter of interest, if you can take a look at that second column from the right, the mean annual return for the deciles, you can see that the 10th decile is not outperforming many of the other deciles over this 35-year period of time or what have you.
Good point. Good point. So let's go back, do the build-up model. We've selected our risk-free rate, our equity risk premium, our size premium, very small, but 0.97%. We're going to, and again, just to reemphasize one of the points we were making, you can input your own equity or industry risk premium if you desire, as opposed to using beta. And let's just say we're going to take 2% for the industry, and let's say 4% for the entity itself, and then we look at the buildup of that rate, and it's 11.87%, a relatively low number, which is driven more than anything by the lower size premium that's used in the calculations based on the data that's being calculated from the CRSP data that we use using the reference year starting in 1982, in this case through 2014. So you do have the flexibility to go back in time. I'm not sure how far. I think you can go back to as far as you want in terms of the valuation date, and then you can, again, use whatever returns reference year you'd like, the three choices or something custom. And with that, unless there's something else you can think of that we ought to look at, Mike, I'll put the screen back.
Let's just do one more thing. I see another question there. Put in a much earlier valuation date, such as year 2000. This is going to be performing just fine.
Okay.
You can click on that on the month there in the middle.
I'll get back there. Oh, okay.
I got you.
There you go. There we go. Okay.
There we go.
2000?
Okay. Yeah. Someday,
okay.
2000. Close.
What would you like to use for a reference year?
I don't think we got the valuation date. Maybe you can just try that again.
Hey, Ron, you can type over the 2015, which is 2010, if you'd like.
Okay. Let's do that.
Oh. And then
what date do we want? Okay.
Yeah, that's good. There we go. And then there's a reference year, 2001, and everything's going to be as we expect, I think. So the general idea here is flexibility. It empowers the practitioner. Everything's transparent. for equity risk premium, for instance, using historical. It's going to give you transparent information, what the S&P 500 average returns have been from the beginning year through the year that you're selecting at the end. S&P 500 is given to you, the risk-free rate, the average return for the risk-free assets is in there. Then for the size premium, it gives you all the deciles, 1 through 10, actual return, S&P 500 return, the difference between the two, and then you have some combinations of the deciles such as microcap. We're trying to make this as transparent as possible so you have the information to make professional judgments that should be made, cost of capital estimates.
All right, Mike and Ron. So we've had a couple of questions like this, so I'm going to kind of group them together. Essentially, they're asking if they can use the cost of capital professional to come up with a cost of equity estimate for a non-U.S. company.
This question has to be done on a case-by-case basis. So if you're the country of, it's one thing to ask for cost of equity for the UK, and there's a lot of technical issues regarding country risk premium. It's way beyond our scope. If you don't believe that that a country like UK or Germany has a country risk premium, you might be able to get to a starting point, but even then you get into some other issues such as differences in inflation expectations and overall economy locally. Too complex to deal with here. Dr. DeModeren has written extensively on country risk premium and how to try to adjust for it using developed country information. So I'd suggest to answer that, take a look at those papers. If you're in a developed country such as Germany, the UK, and so forth, I think you got a good starting point, but you still need to work with it. If you're doing an undeveloped country such as Belize in my example, I think that there's a higher hurdle to start with the U.S. and get to Belize.
All right, so we have another question. It's, for the risk-free rate, do you use the yield or total return?
Risk-free rate for, that's the yield on the valuation. That's the yield on the valuation date. I'm assuming the individual asked for the risk-free asset for the equity risk premium. I'm not certain what he asked for, but for the risk-free rate in the CAPM or build-up, where the expected return equal risk-free rate plus something else, if he's talking about the first parameter, risk-free rate, that's based upon the spot yield as of the valuation date. That's yield to market based upon the price of the security. If the person who wrote the question is asking about the return on the risk-free asset, that's part of the equity risk premium. That's on the return by owning a risk-free asset in comparison to the return of the S&P 500. That's total return. I know that some practitioners get into this debate, and this is one of those debates where I think are how many angels dance on the head of a pin. Should that calculation for equity risk premium be the S&P 500 minus the risk-free asset excluding the capital appreciation? That is an angel who dances on the head of a pin. I've looked at the data and going back for decades at capital appreciation on T-bonds, and it's not statistically different than zero. So the issue of whether you do income returns or capital appreciation returns or whatever for equity risk premium, if the argument is you exclude capital appreciation returns from that, it's an academic argument because over time, as you might expect, the price differences rise and fall based upon changes of interest rates, and on average, it's close to zero. It's statistically no different than zero. So long story short, I believe that our methodology captures real-world expectations, the S&P 500 minus what's actually been earned on owning a risk-free asset over that same period of time. We're not carving out capital appreciation out of that because I just can't see that over time, over long periods of time, that it's statistically different than zero, which is what we would expect. Sometimes the price of T-bonds will go up, sometimes they go down, mostly driven by changes of interest rates, and overall it's a wash. It's very close to zero.
Okay, so we have a user here that said during their free trial that when they were, playing around with the different start and end years, that during some short periods they got a negative. I think they must be referring to the size premium. So they received a negative value based on a time period that they used with a start and an end date, and they ask, what do they do if that occurs?
You got me. I don't think that you'll get a cost of equity that's negative.
Yeah, I think it might have been the size. I don't know, maybe a size premium. They didn't specify specifically what it was, but.
If someone comes up with a combination to get that, send a question to the technical support, and we'll diagnose it.
Okay. And we have another question here. They ask if the tool calculates the unsystematic risk premium, and if so, where does that come from?
Short answer is no. And where does it come from? It comes from professional judgment. There's no computer algorithm out there that can determine reliably, with precision, unsystematic risk in a privately held company. It's just not. So trying to get a computer to do that is an exercise in futility. If somebody can write a model for that, let's test it and let's see if it's reliable, but I don't think it can be done.
We have another question here, and they ask, are there any issues that are created by using a size premium that is not adjusted for CAPM if they're using a CAPM with beta?
I think that's going to be professional judgment. So if you want to use CAPM on decile 10, it's going to be a high beta. What the platform provides only is the difference between the decile return and the S&P 500. I think that if you want to apply CAPM with a high beta for decile 10, if you apply the capital asset pricing model, I think you're going to have to go through a little bit of arithmetic, which we're not going to do for you, to adjust that size premium we provide for decile 10 to account for using a capital asset pricing model.
Okay, so I think we've gone over about 15 minutes, so I think we're going to wrap it up. So before I read any of the closing statements, Dr. Crain and Ron, did you have any final thoughts before I finish this?
The only thought that I'm going to have here is just to reemphasize a couple of brief points. Number one, I really encourage people to think about the idea that more complexity is not necessarily the right path to get you to a more precise answer. That's the illusion of precision. Second point I want to leave with is you cannot eliminate all or most of professional judgment out of doing business valuation and cost of capital models any more than you can get a computer to estimate the estimated cash flows in the numerator of a DCF model. That's all professional judgment, human intervention based upon training, skills, expertise, and knowledge, and we're trying to provide all of this information to you in a transparent, way so everyone can apply their own professional judgment to the matter at hand for their evaluation.
Just one small add that will, I think, just be a little redundant with what Mike just said, but this is not a substitute for the qualitative and quantitative work that needs to go into any evaluation in advance of the professional judgment choices that we are now empowering the users with within this platform. So it's not a black box, and it's not computing the things for you that you need to make informed decisions on.
And let me one final point, and then back to you, Adam. I saw a question in there saying, well, why don't you include Pepperdine's information into here? Well, you know, we could, in theory, include everybody's information in there if only we could find everybody's information. But that's not to preclude you from using Pepperdine. If you want to extract some information out of some other source, such as that one, and put it into here and then run it all through, you can certainly do that. Feel free. The power's there. User inputs are all there to do whatever you want.
Excellent. That's a very good point. And I do know that we still have some outstanding questions, and I want our listeners to know that we will answer those after our webinar at a later date. And I know some of them are concerning pricing, and just to let everybody know that will be available on our webpage starting in December, or you can reach out to us if you have any other further questions. So on behalf of BVR, I want to thank Dr. Michael Crain and Ron Seigneur for an excellent presentation, and I want to thank all of our listeners for attending.